$59.32. Silver just demolished every price record in modern memory. Today is December 6th, 2025. But here's what really grabbed my attention. While prices were surging, JPMorgan reportedly transferred approximately 169 million ounces of silver into their storage facilities. Industry analysts estimate that represents roughly 9% of the entire global supply. And they've been quietly stockpiling since 2011. That's 14 years of methodical accumulation. Now, I keep wondering, if silver truly doesn't matter, as countless experts have claimed, then why would America's most powerful financial institution be amassing this metal? My theory is straightforward. Something major may already be happening beneath the surface. I've been researching a historical pattern that emerges in every significant financial crisis. A pattern that has never once failed. And right now, based on everything I'm observing, that pattern might be completing before our eyes. You still have options, but the opportunity may be disappearing quicker than you realize. I'm not a financial advisor. This isn't financial advice. I have no affiliation with anyone mentioned. Everything presented here is educational analysis derived from publicly available information. After months of studying previous financial meltdowns, I discovered something remarkable. They all progress through identical 4 phases, and silver, from my perspective, has entered the final one. Phase 1 is what I call the foundation. Authorities manufacture apparent stability. Prices remain artificially suppressed. Paper markets balloon. Everyone has faith in the system. For silver, this started after the Hunt brothers episode in 1980. Regulators feared price swings and constructed a massive paper framework estimated by some analysts at nearly 50 times larger than the physical market. What's remarkable is that COMEX data reveals open interest at approximately 244% of vaulted silver, meaning if even a small percentage of paper holders requested physical delivery, the system could experience serious problems. Phase 2 is growth. The divide between paper promises and physical reality expands. Debt balloons. Money printing accelerates. Promises layer upon promises, yet prices stay suppressed. In my assessment, we've been existing in Phase 2 since 2008. Central banks globally reportedly printed more than 30 trillion. The United States alone created around $8 trillion, yet silver didn't surge. Why? Because whenever physical demand grew, major banks allegedly saturated the market with paper contracts, short positions, and derivatives. Prices stayed locked below $30 for almost a decade. Meanwhile, industrial consumption exploded. Solar panels require silver coating for electrical conductivity. Electric vehicles utilize roughly 3 times more silver than conventional automobiles. 5G infrastructure, artificial intelligence data centers, medical technology, they all depend on silver. Estimates indicate industrial usage now comprises about 59% of total silver demand, compared to approximately 40% just 10 years ago. But mining output hasn't matched pace. Reports indicate global silver production has declined around 7% since 2016. Analysts describe this as a structural deficit, more silver consumed than extracted for roughly 7 straight years. Where does the additional supply originate? Above-ground reserves, vaults, and stockpiles, all being depleted. India's silver imports reached unprecedented levels. China has been purchasing consistently, yet paper prices remained suppressed until now. This is where it gets fascinating. Multiple market analyses indicate that since April 2011, JPMorgan has accumulated an estimated 675 million ounces of physical silver. If accurate, that represents approximately 45% of the world's above-ground supply in 1,000-ounce bars. More than the Hunt brothers ever controlled, more than Berkshire Hathaway held, more than many entire countries possess. So why would they do this? Here's my interpretation. When JPMorgan acquired Bear Stearns in 2008, they inherited enormous short positions. For years, they were reportedly trapped on the losing side of the trade. Then something shifted. According to analysts, they covered their shorts and went long, aggressively long. COMEX data suggests they currently hold around 169 million ounces in COMEX vaults alone, nearly 40% of all inventories. The gap between paper claims and physical metal has never been greater. Phase 3 is the fracture. The moment something breaks, it might be technical, it might be political, but suddenly everyone demands physical metal, not paper promises. And there simply isn't enough to go around. I believe we're witnessing this unfold right now. On November 28, 2025, the CME Group reportedly went dark due to a server cooling malfunction. The outage persisted for over 10 hours. During that period, silver jumped to approximately 56.72, an all-time high at that moment. When the system returned online, bid-ask spreads exceeded $1 apart. That's abnormal. That's what market distress looks like. Then another detail captured my attention. COMEX filings revealed JPMorgan reclassified approximately 13.4 million ounces from registered to eligible. Registered silver can be delivered against futures contracts. Eligible silver cannot. Essentially, JPMorgan removed roughly 9% of deliverable silver from availability during a period of intense demand. That timing isn't coincidental. In October 2025, silver lease rates reportedly reached 30% annualized. When people are paying 30% interest just to borrow metal, that signals desperation and the early stages of a squeeze. Now, here we stand, December 6th, 2025. Silver has reached the $59 range. That's approximately a 98% gain year to date, the strongest performance since 1980. Phase 4 is the eruption. Prices accelerate. Short sellers get destroyed. Institutions positioned early profit massively. And based on what I'm observing, this is where we currently are. History provides us a preview. In 1979, the Hunt brothers saw silver at $6 and recognized the imbalances. Inflation, consumption, limited supply. They purchased about 200 million ounces, 1/3 of America's silver supply. By January 1980, silver reached $49.45, an 800% gain in 18 months. The squeeze was real. The shortage was real. The price was real until COMEX altered the rules overnight, banned new long positions, and forced liquidation. Silver Thursday destroyed the Hunts, but the fundamentals they identified were correct. Now, imagine the identical setup, but instead of two billionaires, the buyer is a bank that helps create the rules. That possibility is what troubles me most. We witnessed something comparable in 2008 with mortgage securities. When paper claims collapsed, capital fled to physical assets. Gold rose from around $720 to over $900, roughly a 167% surge. Paper failed. Reality prevailed. Central banks didn't resolve the problem in 2008. They magnified it, printing around $16 trillion globally, purchasing their own debt, and suppressing rates. That expansion of the paper system leads directly to where we are now. Silver is consolidating just under $60. Analysts earlier predicted $38 to $39 for late 2025. We've already surpassed that. Independent analysts like Lawrence Leopard forecast $75 to $90 by the end of 2026. But those projections assume the paper market remains intact. What if it doesn't? Adjusted for inflation, the 1980 silver peak of $49 equals approximately $170 today. Yet we're sitting at $59. The supply deficit now is worse. Industrial demand is higher. The paper market is exponentially larger. Historically, silver and gold trade at a 15-to-1 ratio. Recently, that ratio has hovered around 72.1. If it corrects, some analysts suggest silver could reach $280 per ounce through simple mean reversion. No conspiracy, just mathematics. The larger question is, what happens when paper holders demand delivery and there isn't enough physical metal to satisfy them? What happens when pension funds, sovereign wealth funds, and retail investors all attempt to secure silver simultaneously? That scenario is what keeps me awake at night. In 3 days, December 9th and 10th, the Federal Reserve convenes. According to Bloomberg, there's approximately an 87% probability of a rate cut. Historically, rate cuts weaken the dollar. And when the dollar weakens, gold and silver surge. Gold is around $4,200 currently. Some analysts see it reaching $4,500 to $5,000 in 2026. Silver follows gold always, but moves faster, more violently, more explosively. The Fed meeting could be the trigger. The structural deficit is the fuel. JPMorgan's positioning might be the accelerant. And the strained paper market could be the detonation. Physical silver is still obtainable, but premiums are climbing and some dealers report delays. That window may not remain open. During system stress, premiums can jump 30%, 40%, even 60%. In 2020, silver hit around $28, but physical coins sold for $45, nearly a 60% premium. Imagine that happening with silver at $100. COMEX currently reports approximately 113 million ounces of registered silver. If that drops below 50 million, the market could face significant strain. At the current withdrawal pace, that could occur within 6 to 12 months, maybe sooner if there's a rush. This isn't merely about silver. Silver is the indicator. The dollar is the underlying issue. Since 1971, when the gold window closed, the dollar has been backed not by physical assets, but by confidence and productivity. After 50 years of printing and structural deficits, some economists argue inflation has been concealed by modifications to CPI methodology. The bill may be coming due. Gold is at record highs, silver is at $59, energy costs are rising, institutions are moving into hard assets, markets appear to be delivering the same message. Scarcity matters. And silver, relative to gold, industrial usage, and money supply expansion, may be the most undervalued, scarce asset on the planet. It took 45 years for silver to break its previous record. 45 years of suppression, accumulation, and compression. Now we're here, $59 and climbing. The Hunt brothers were premature, they got crushed by the system, but their analysis wasn't wrong. Now imagine that identical setup, but with JPMorgan instead of the Hunts. They know the rules, they help shape the rules, and they don't need to force a squeeze. They can simply allow the market to unwind naturally. If silver reaches $100, then $150, then $200. If it does, they'll be positioned long before the public comprehends what happened. Every signal appears to be flashing the same warning. Record highs, supply deficits, bank accumulation, paper market stress, geopolitical tension, and a major Federal Reserve decision just days away. That's not coincidence, that's convergence. You don't have to believe me, just study history. Because history has a habit of repeating. I'm not a financial advisor, I'm simply someone studying these patterns and trying to make sense of what's unfolding. The silver shift isn't coming, it's already here. The only question is whether you all understand it now or look back 6 months from today, wishing you had paid attention. When I examine everything converging right now, I keep returning to one question. Why is all of this happening simultaneously? Silver hitting new highs, gold at record levels, the dollar weakening, central banks preparing for a possible pivot, major banks shifting physical inventory quietly, almost surgically, industrial demand soaring, and geopolitical tensions pushing nations to diversify away from dollar-based systems. These things are not random. They form a pattern, one that becomes obvious only when you step back far enough to see the complete picture. The more I study these cycles, the more I'm convinced that silver isn't the main story. It's the signal. It reacts earlier and more violently than gold because it sits at the intersection of money and industry. When silver moves, it often means something underneath the system is shifting. When silver explodes, it often means that shift is accelerating. And that's exactly what I think we're witnessing right now. The reaction we're seeing in the silver market might be the first visible crack in a financial structure built on promises, leverage, and artificially suppressed volatility. People often misunderstand what makes silver different. Gold is the ultimate monetary metal. It sits in vaults, it doesn't corrode, it's held as a reserve. Silver, however, gets consumed. It disappears into solar panels, electronics, batteries, and medical equipment. Most of the silver mined each year doesn't return. Once it's used, it's gone. That's why structural shortages matter so much. If industrial demand keeps rising and mines can't keep up, the gap has to be filled from above-ground stockpiles. And that's exactly what we've been observing. Slow, steady, systematic drainage of inventories from both east and west. But here's what surprises me. Even with all these signals, most people still don't grasp what's unfolding. They look at silver and think it's a small market, irrelevant compared to stocks, bonds, or real estate. They don't realize that this small market might become the pressure valve for a much larger system. When trust in paper assets weakens, capital moves into physical assets. And silver is one of the few assets that still trades at a price far below what supply and demand fundamentals suggest. Something else I've noticed while following this closely, the behavior of institutional players has changed. For years, large banks allegedly used heavy shorting to control silver's price. But now, instead of suppressing it, they appear to be positioning themselves ahead of a major move. JPMorgan's accumulation is not random. It is deliberate, patient, and strategic. You do not accumulate hundreds of millions of ounces over more than a decade unless you expect something significant. And you certainly do not pull registered silver out of circulation right at the moment of maximum stress unless you believe scarcity is becoming a real risk. Take a moment and consider that timing. Silver lease, rates spiking, COMEX inventories draining, global mints reporting record demand, industrial consumption accelerating. And right in the middle of all that, JPMorgan reducing deliverable supply. It almost feels like they know what's coming. Maybe they see deeper liquidity issues in the paper markets. Maybe they anticipate geopolitical realignments that could disrupt supply chains. Or maybe they're simply preparing for the inevitable unwinding of a decades-old imbalance between paper contracts and physical metal. Either way, the message is clear. They want the metal, not the promise. Whenever I analyze moments like this, I look back at historical parallels, and there's one that keeps resurfacing. The late 1970s. Not because the Hunt brothers tried to corner the market, that's the surface narrative, but because the fundamentals were remarkably similar. Inflation rising, monetary policy lagging behind reality, industrial demand climbing, political uncertainty, and above all, a population losing trust in official economic narratives. Back then, silver was the release valve. Today, the situation feels even more extreme because the amount of debt, leverage, and money creation in the system has multiplied exponentially. But there's a crucial difference between the 1980 silver run and the one we might be seeing now. In 1980, financial markets were tiny compared to today. The majority of trading happened among individuals and smaller investors. Today's markets are dominated by institutions, banks, hedge funds, sovereign wealth funds, pension funds. These players move billions, sometimes trillions. If even a tiny fraction of institutional capital shifts into silver, The available supply simply cannot handle it. That's not speculation, that's math. When a small market meets enormous demand, prices don't just rise, they spike violently. Another thing worth noting is how fast sentiment can change. A few weeks ago, most analysts were still calling silver dead money. Now the same people are scrambling to revise their forecasts. Some have started calling for $75, others for $100. And a few bold voices are suggesting silver could test $150 within a year. But what amazes me is how almost none of them are addressing the structural deficit or the distortions caused by the paper market. They're still treating silver like a normal commodity, not a monetary metal under extreme pressure in a fragile global financial system. And one event I'm watching closely is the upcoming Federal Reserve meeting. If the Fed cuts rates, and with an 87% probability priced in, it seems almost certain the dollar could weaken sharply. And when the dollar weakens, hard assets move. Gold, silver, energy, commodities, they all respond. But silver responds faster and more aggressively because it's smaller, thinner, and more volatile. A single policy decision could ignite a chain reaction. And once the move begins, momentum traders, algorithmic funds, and retail investors might all pile in simultaneously. That's when you get parabolic moves. Think about what happened earlier this year when copper exploded. It wasn't because people suddenly needed 30% more copper. It was because supply chains tightened, inventories dropped, and speculators piled in. Silver's market is even smaller than copper's. If that kind of speculative rush happens in silver, $59 higher could be just the opening act. Historically, silver doesn't move gradually. It moves in violent surges, long periods of sideways action followed by sudden explosive breakouts. And if the imbalance between physical and paper markets snaps, a breakout could happen far faster than people expect. There's another layer to this story: geopolitical shifts. Over the last 2 years, several countries have openly expressed interest in reducing dependence on the US dollar. Nations are settling trade in local currencies. Central banks are buying record amounts of gold. Some are even exploring commodity-backed settlement systems. Silver doesn't get as much attention in this conversation, but it plays a quiet, essential role. If gold is the foundation of monetary confidence, silver is the bridge between monetary and industrial utility. Any system moving toward real assets naturally increases demand for both metals. I also keep noticing the behavior of retail investors. During the 2020 silver squeeze attempt, physical dealers across the world ran out of supply within days. Premiums skyrocketed. Delivery times stretched into months. And that was during a moment driven mostly by social media excitement. Today, the situation is different. This move isn't driven by hype. It's driven by fundamentals. Industrial demand is real. The deficit is real. Inventories are shrinking. And institutions are quietly accumulating. If retail investors enter this time, they're entering a market already stretched thin. All of this leads me to one conclusion. The silver market is reaching an inflection point, a moment where supply, demand, monetary policy, and investor behavior intersect. And inflection points are where history often turns. When prices break long-term ceilings, market psychology changes. Investors who ignored silver for years suddenly start asking questions. Institutions that dismissed it as too small start reconsidering. Funds that avoided it due to low volatility begin to see opportunity. And as interest grows, liquidity tightens further, creating a feedback loop that accelerates prices higher. In the middle of all this, one thing stands out to me. The general public has no idea what's happening. Most people are focused on stocks, crypto, real estate, or inflation headlines. Silver barely enters the conversation, even though its price movement is one of the clearest signals that underlying financial pressures are rising. If you show the average person a chart of silver's long-term price against global money supply expansion, the relationship becomes obvious. But most people never look at that chart. They don't see the pattern building beneath the surface. Meanwhile, physical premiums keep rising. Dealers are reporting increased demand. Some are quietly raising minimum order sizes. Others are warning that certain products may not be available if demand continues. This is exactly how shortages begin. Slowly, then suddenly. At first, only specific products sell out. Then larger bars become scarce. Then delivery times extend. And finally, the whole market shifts into a scarcity mindset. We saw this during the 2020 supply chain crisis. Once fear takes hold, demand doesn't rise gradually, it spikes uncontrollably. Every time I dig deeper into this, I'm reminded of something a metals analyst said years ago. Silver is the most emotional metal. And it's true. It reacts to fear, inflation, scarcity, and speculation all at once. It moves dramatically when confidence drops. It becomes volatile when liquidity tightens. And because the market is so small relative to global capital flows, even minor shifts can trigger massive price movements. That emotional component is what makes silver both incredibly risky and incredibly powerful. As we move closer to the Fed meeting, I expect volatility to increase. Traders hate uncertainty, and the combination of rate cuts, geopolitical tension, and structural shortages creates the perfect setup for unpredictable moves. If silver breaks convincingly above $60, I believe momentum traders will jump in. Once that happens, the algorithms follow. Then retail follows the breakout. And at that point, physical supply will face even more pressure. A breakout above $60 isn't just a price level, it's a psychological threshold. I want to be clear about something. Nothing goes straight up. Silver will have pullbacks. It will have consolidation periods. But those pullbacks might become shorter and more violent because the underlying supply crisis isn't going away. The deficit is real. Industrial consumption isn't slowing down. Mines aren't suddenly increasing output. And above-ground inventories cannot replenish themselves. Markets can ignore fundamentals for a long time, but not forever. And in my view, silver has reached the point where fundamentals are overpowering suppression. Every major financial shift begins quietly. A few price anomalies, a few policy changes, a few large players moving early. Then suddenly the public wakes up and realizes the world changed months ago. I think that's what's happening now. The world is shifting toward hard assets while most people are still trying to understand inflation. Silver is reflecting that shift before the broader market catches up. As we enter the next few weeks, I'll be watching several key indicators closely. Registered silver levels on COMEX, lease rate pressure, refinery premiums, delivery times, and institutional flows. These indicators reveal stress long before price charts do. And right now, all of them point toward tightening supply and rising demand. If the trend continues, silver could become one of the most important financial stories of the decade. Not because of speculation, but because it exposes a deeper structural issue inside the global monetary system. And that's why the next move matters so much.